I am very happy to introduce you the various factors that are influencing depreciation in making our accounts. Actually, what is the background information? What is the foundation for depreciation? In financial accounting, it aims to ascertain the true and fair amount of the profit earned or loss or incurred during the financial year. In case of fixed asset, actually the amount spent on acquiring it is one time, but the asset is going to be used for more than 1 year. So that becomes inevitable to include a portion of that amount spent on that fixed asset while calculating the profit in every financial year. So this is the foundation concept of depreciation for providing depreciation, and while preparing accounts we must take into account definitely. Now what this depreciation is? It is the amount charged against the income, as we all know. It is made every year. It is made before ascertaining the true profit or loss. Otherwise, your profit will not be the correct one. It is relating to the use of any depreciable asset. So, if an asset is not the depreciable one, then depreciation need not be provided, right? Then it is in that asset is to be used in earning that income, then only that can be charged. Again, it is in proportion to the extent to which the particular asset is used in earning such income. Normally, it is made during an accounting year. So, depreciation is the amount charged against the income every year before ascertaining the true profit or loss relating to the use of any depreciable asset in earning such income in proportion to the extent of use of the asset during an accounting year. So what about the definition? Because we are always fond of the definition than meaning. Depreciation is the measure of wearing out, consumption, or other loss of value. It may be of any kind of the depreciable asset arising due to or arising from the use or reflection of time or obsolescence. Obsolescence that happens due to the technology or market changes. So this is a comprehensive and widest definition given by the Institute of Chartered Accountants of India. Now we go to our subject. Before entering into the factors, let me clear about some of the terminologies that are more closely associated to depreciation. One is depreciable amount. This is a normal concept. Of an asset is the historical cost and the installation. You have to add it together. Less residual value that you have to deduct. So now DA is equal to C plus I minus R. This is a basic thing. Then second one is the useful life of an asset. It is either in terms of the period, that is number of years for which the depreciable asset is to use, or the number of production of similar units expected out of the asset throughout its lifetime. Right? So, this is the two ways of expressing the useful life of an asset. Naturally, useful life is shorter than the physical life of the asset. That is also there. Now, the next concept is the residual value of an asset. It is the value that the asset would fetch at the end of the useful life. Say maybe 10 years. After 10 years, what would be the value? So, such an amount you have to estimate. So, if the value is negligible, it is considered as nil. So, it will not be accounted for. Otherwise, in many cases, it will have some value, maybe in thousands or lakhs, depending on the value of the asset. So, that is to be estimated scientifically. You must be carefully estimating it and is used for accounting. This residual value, normally it is having other name such as stand-in value, breakup value and the like. Now, we come to the main concept of our discussion, namely the factors. So, as you find in this slide, we have 4 factors: historical cost, installation expense, expected useful life and estimated residual value. These 4, they decide what the depreciation is. The depreciation can be either annual or per unit of output. The numerator is the same, but the denominator will vary. If you are stating the lifetime in years, that will be annual depreciation. If you are saving the lifetime in terms of expected output, then you will have the per unit of output. So this is the formula actually you can use for finding the depreciation based on the 4 factors. Now, let us use an example. If suppose the cost of the asset is 3 lakhs and it has the installation expense of 1 lakh and the residual is of 40,000, then the depreciable amount will be 3 lakhs plus 1 lakhs minus 40,000, namely 3 lakhs 60,000. And the lifetime, if it is happen to be 10 years, then the per year depreciation per annum would be 36,000. This is one dimension. In another way, if the cost is 5 lakhs and installation is 2 lakhs and the residual value is 1 lakh, then you have the depreciable value of 6 lakhs. Here the lifetime, instead of the life quantity of output is 3 lakhs tons. So you divide the 3 lakhs tons for these 6 lakhs, you have 2 rupees per unit of output. So this is the depreciation. After, suppose if you in particular year you have produced 40,000 units, in the sense multiplied by 2, you have 80,000 as depreciation. According to the output, we can have the depreciation, annual depreciation, right? Now, so this is for your review. If in this session you know what is depreciation, what is a depreciable value, how to find what is the formula for calculating depreciation, and the main concept of our presentation, namely the factors determining the decision. Okay, so these 2 examples will help you to understand the concept well. So with this we are completing. Thank you.